A small difference in your credit score can have a huge impact not only on your interest rate and your monthly payment, but how much loan you actually qualify for. In fact, your credit score is more important to the loan process than any other factor in there, including your down payment. In today's video, we're going to talk about what you can do to improve your credit score. We're also going to discuss some misconceptions around credit, in addition to showing you some examples in how much that difference in credit score actually impacts your interest rate. We're going to be doing it on both conventional and FHA loans so that you can see firsthand how important your credit score is. Now, I know some of the people watching this video will say, well, Jeb, I'm not looking to buy a house, therefore my credit doesn't really matter. Understand, your credit really impacts everything you do in your life, from the interest rate that you get when buying a home, but also the interest rate that you get when you decide to buy a car. In addition to that, it also has an influence on credit card approvals, and with that, how much you'll actually get approved for or whether you get approved at all. And if that wasn't enough, it also impacts non-credit situations, things like renting a house. If you go to rent a property instead of buying, say you decide I'm going to rent now and I'm going to buy later, understand that the landlord is actually looking at your credit score when deciding whether or not they're actually going to rent to you. So please know your credit score is really, really, really important. But on that same token, I want to throw something out there. There's a lot of companies out there that do credit repair, that charge these crazy fees and say that they'll help improve your credit score. Now, while some of these might actually be the case, they can improve your credit score, you really shouldn't have to pay some crazy fee in order to make it happen. And something else to keep in mind is sometimes these credit reporting companies can get things removed from your credit that will make your score pop, and then a couple of months later, those things pop back on your credit. So when you're talking to credit repair companies and you're going through that process, just make sure that whatever they're promising is actually the case so that you're not wasting money on credit repair that's not actually helping your credit score. But with that, I want to talk about some things that you can personally do to help improve your credit score. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on things like this, along with everything real estate related, do me a favor and hit that subscribe button. So when it comes to improving your credit score, the very best thing you can do is make sure you pay your bills on time. Now, you're probably watching this going, Jeb, that's not rocket science. Of course, I need to pay my bills on time, but how do I actually improve my score? Well, we are going to dive into that in just a minute. I just want to take a minute here and talk about how important paying your bills on time is, because whenever you're late in making payments, these companies report that to the credit bureaus, and in turn, you can get things on your credit like 30-day late, 60-day late. And when those things happen, it has a huge impact on your credit score, even if that's the only blemish that you actually have. Now, often when I talk about being late, understand, if the payment is due on the 1st of the month and you make it on the 5th of the month, yes, you're late, but that's not going to be reported to the credit bureaus. It's not actually reported to the credit bureaus until you're more than 30 days late, which in theory means you have about a 30-day grace period from the time that that bill is due before it actually reports to the credit bureaus. So don't think just because I'm late, well, it doesn't matter now, I'm just going to deal with it later. No, if you can make that payment, make sure you're making it within that time frame so that it doesn't impact your credit score. But if you're already in the position where you have a credit score, you're making your bills on time now, maybe you had some issues in the past and you're wondering how you can improve those scores, one of the very best things you can do is focus on credit card utilization. What does that actually mean? Well, it's the amount of debt that you're charging on, say, a credit card versus whatever the limit is on that card. So let's say, for example, we have an American Express card that has a $10,000 limit on that card. And let's say for purposes of this video, I'm using $7,500 of that $10,000. So that means I'm using 75%, a 75% utilization of that credit card. And a lot of people don't understand how negatively that actually impacts your credit score, because one of the things that makes up your credit score is the utilization of the actual limit on that card. And in theory, you want to be 50% or less of the limit of that card. So in our example, we had a $10,000 limit. So ideally, our balance is less than $5,000 on that card, because that will help improve our credit score. But if you can get it to 35% or less of that credit limit, so in this case, $3,500 of that $10,000 balance, then in that case, it's likely going to boost your score. Now, there's a couple of ways to go about doing this. The first way is you can just pay down the balances of that card, right? So if you have a $7,500 balance on that card, has a $10,000 limit, you can go in and pay $4,000 on that card to get you down to $3,500, which in turn should improve your credit score. But I know most people watching this video going, Jeff, if I had an additional $4,000, I wouldn't be in this position. I don't have that money to pay down that balance. So in turn, the very next thing you can do to help out in that situation is call the company that your credit card is at and see if they'll actually raise your credit limit, which in the case that you've been making your payments on time and you haven't requested a limit increase anytime soon, then chances are they're likely going to give you that increase. So say, for example, they take you from $10,000 up to $15,000. Well, if you had that balance of $7,500, you're now less than 50% utilization on that card because you have a $15,000 limit, which in turn will improve your credit score. Now understand, as soon as you make the payment or you get that limit increase, your score doesn't jump automatically that day. You have to wait for the credit bureaus to report this information in order to see that change on your credit report. And many times this can take 30 days, even 60 days, depending on when you actually got the limit increase. But another thing you can do to actually improve your credit score is become an authorized user on someone's account that has good credit. Say, for example, your boyfriend, your spouse, your girlfriend, your dad, your mom, whoever it is, has a credit card that they've had for an extended period of time and they've always made their payments on time and they have good credit. Well, you can become an authorized user of that account, which basically means they are granting you access to have a card in your name that they are more or less responsible for. Now, you're probably not going to get some stranger off the street to do this. You're going to have somebody that knows you, likes you, trusts you in order to get them to sign off on this. But just being an authorized user doesn't mean you actually even have to use the card. But as soon as you become the authorized user on that account, guess what happens? Their credit history now reports under your credit score for that particular card, which in turn should cause your credit score to increase as long as they've been making their payments on time. Now, you don't want to go out and become an authorized user on somebody that hasn't been making their payments on time or who has maxed out credit cards above that 50% utilization, because if that's the case, then that's going to negatively affect you. You ideally want to find someone that has big limits on there and they're using a very small percentage of that credit card, because in that way, it's going to have a positive impact and likely raise your credit score. Now, one of the other things you can do to help improve your credit score is if you're a renter out there, someone that doesn't own a home, and you don't really have a lot of credit out there, you can now use one of the rent reporting services out there that will allow your landlord to report how you've paid your rent, how you've paid your utilities, these different bills on time. And by doing this, that information will now report on your credit report, because otherwise, stuff like rent, stuff like utility bills, cell phone bills, those things don't report on your credit report. Your credit report is primarily made up of things like installment debt, revolving debt, student loans, that sort of thing. So things like car payments, credit cards, student loans, things that you typically have to use credit in order to get approved for, those are the things that show up on your credit report. Things like rent, that sort of stuff typically doesn't report. But if you're someone who does make the payments on time, that can be something that can have a positive spin on your credit report, especially if you have a long history of doing it. And that's another thing that has an impact on your credit score, is the history of these accounts. If you're someone that's trying to improve your credit or trying to establish a credit score and you're going out and you're applying for all of these different credit cards, well, one thing is you're getting inquiries on your credit report, which can have a negative impact on your credit score, especially if you're doing a lot of them at one time with a bunch of different companies for all types of credit. Now, if you're getting a mortgage, you essentially have 45 days from the time you apply with the first lender to shop that loan around for other lenders to pull your credit report, and that shouldn't negatively impact your credit score. But if you're someone trying to build credit, or you're trying to get more credit because you're in a stressful situation and you apply with American Express, and then you go to Discover, and then you go to MasterCard, and then maybe you're trying to get furniture and you go to Macy's, and you do all of these different things, well, all of those inquiries are going to have an impact on your credit score, and that's something you want to try to avoid. On top of that, you don't really want to close credit cards that you're no longer using, unless you just can't be trusted with that account being open. Now, there's a lot of people out there saying, hey, if you're not using that credit card, you should close that account. Well, that can actually have a negative impact on your credit score, because one of the things the bureaus look at is how long you've had accounts open, whether you're using them or not. So if you've got a credit card that's 10 years old and you've just decided, hey, I'm no longer going to use it, it doesn't have a yearly fee, but I'm just going to close it anyway because I don't want to have that credit card over there just sitting open. Well, if you decide to close it, that can actually impact your score in a negative way. So instead of closing the account, just cut up the credit card and forget you have it and don't use it. And that way it'll continue to report to the bureaus that you you have that credit line out there and you're not using it, which in turn means you have no utilization on that card, which is a positive thing when it comes to credit scores. Now, earlier in the video, I talked about the idea of paying down your credit card balances if you can do it. I'm a big believer in Dave Ramsey's Snowball Method, which is the idea that you take all of your credit card balances and you label them from smallest to biggest. And instead of trying to pay the biggest one first, which is what a lot of people out there preach, he preaches the idea of focusing on the smallest balance first and using all your momentum to pay off the smallest balance as quickly as you can. And once you pay off that small balance, you take the money that you were paying towards that small balance and you now use it towards the next highest balance. So now you're putting all your effort in paying the second smallest balance while still paying the minimum on all the other cards. So this does a couple of different things. One is it allows you to pay off these credit cards quicker, which in turn will give you some momentum. And as you get that momentum, you'll start to feel good. And now as you pay off that second card, you take the money that you were paying towards the first and the second, and you use it towards the third. And that's exactly where that snowball method comes from. Now, I know a lot of people out there want to focus on the highest interest rates first and get that debt out of the way, and I can completely understand that, but sometimes that can be completely overwhelming trying to manage all of these different things. So in turn, the snowball method allows you to kind of get things rolling, get that momentum, pay these cards off, and continue down that path, which in turn will improve your credit score. Now, while there's some other things that you can do to focus on improving your credit score, those are really the things that I would focus on. That's trying to increase my balances. You know, that utilization is really the biggest part, not going out and trying to apply for a bunch of different credit cards. Keeping the credit cards that I have that I'm not using, I would keep them open. And more importantly, just make sure you're continuing to make your payments on time while you're going through this whole process. Now, there are some misconceptions that often come up when talking about credit scores. And one of them is checking your own credit score actually impacts your score in a negative way. Understand, you can actually get a free credit report one time per year where it will actually have little to no impact on your credit score. And that's because it's a soft inquiry in your credit. With that, it's important to look at your credit score, but you don't need to look at it on a monthly basis. That's really why they only allow these free credit reports one time per year, once annually, is because you don't need to be out there monitoring it month over month. In fact, if you want to get a copy of your free credit report, I'll put a link in the description below. Another misconception that often comes up is if I pay something, a collection or something else that's negatively reporting on my credit report, it's automatically going to go away or it's going to have a negative impact on my credit score. Understand, sometimes, yes, it can have a negative impact on your credit score. So when you're going through the process, if you're in the process of buying a home or going through that, talk to your mortgage professional about what it is you're paying off to see if it's actually necessary for you to pay it off in order for you to get the loan. Sometimes you don't need to pay this stuff off and you could still end up with the same rate and term on your loan. But in other cases, it might make sense to pay it off because in turn, by doing it, it could improve your credit score. But if you're going to pay something off, make sure you call the company that's reporting the collection prior to doing it and see if they'll provide a letter of deletion upon you paying that balance. And what am I talking about here? Well, that says that they will remove that item, that line item from your credit report if you decide to pay it off. If they say they won't remove it from your credit report, then chances are it's not going to improve your credit score. So if you're going to pay off the collection, you want to make sure in turn that they're actually going to remove it from your credit report. And if they do, then it's likely going to have a positive impact on your credit. But something to understand, if they're old collections, they're 5, 6, 7 years old, chances are it's not really going to impact your credit score at all. So if that's the case, just make sure you're prioritizing the things that you're paying off and where you're putting your money so that it has the biggest impact on your credit score. Some other things that I often hear is that your income impacts your credit score, and there's no validity to that at all. Your income has nothing to do with your credit score. Your credit score is made up of how you make your payments, whether you make them on time or not, the credit card utilization that we talked about earlier, the history of your accounts, the inquiries that you're applying for with new credit, along with the different types of credit that you have. So with that, your income has no correlation to your credit score at all. And another thing I want to point out in today's video before looking at the numbers that we mentioned earlier is that sometimes you'll get a credit score with your credit card company, right? So say, for example, when you log in to make your payment, there's a credit score there. And sometimes it might actually be called your Vantage score, or it might be called something else. Understand that lenders, when you're applying for a mortgage, you're applying for a car, different types of credit, they're not often using the score that you're actually seeing in there. In fact, that score can often report higher than your true credit score. So if you're going to be applying for a mortgage or some other type of credit, just make sure you're talking to a professional, having them run your credit, or going and doing the annual credit report that I mentioned earlier. That way you know exactly what your score is, because if you're basing everything off of the number that you're seeing online in your credit portal, then chances are you're basing it all off an inaccurate number, which in turn could have a negative impact on what you're trying to accomplish. But let's talk about the difference in credit score and what that means for your monthly payment. So I took two different examples. I took a $500,000 loan, for example, and I did it with an FHA loan, and I did it with a conventional loan. And with an FHA loan, they allow credit scores as low as 580, putting 3.5% down. But for this example, we didn't go down to a 580. Instead, we said you had a 620 credit score using an FHA loan and you were financing $500,000. Well, if that's the case, based on today's interest rates, that would give you a mortgage payment of $3,160. Now, we're not factoring taxes and insurance. We're just looking at principal and interest payments here, because the taxes and insurance would be the same regardless of your credit score. And then I ran the same numbers for somebody that has a 740 and decides to use FHA, because FHA isn't just for those with lower credit scores. They also allow higher credit scores. In fact, the higher your credit score, the better the interest rate you're going to get. So in this example, with a 740, using that $500,000 loan amount, you would get an interest rate of 6.125%, which in turn would give you a mortgage payment of $3,038 per month. And while that's only 0.3% difference than that with a 620 credit score, that breaks down to $122 a month. So instead of going through with that loan, if you had a 620, it would probably make more sense to focus on trying to improve your credit score and then go through the loan approval process, because not only are you going to get a better rate, which in turn is going to lead to a lower monthly payment, but it would also allow you to qualify for more home when it comes to your debt to income ratio. And I know some people are watching going, well, that's only $122. It's not that big of a difference. Well, let's talk about a conventional loan with a $500,000 purchase price. In this example, we did 5% down, and we ran two different examples, somebody with a 640 credit score and somebody with a 780 credit score. So we took somebody on the lower end of the scale, and we took somebody on the higher end of the scale. And the lower end of the scale, based on today's rates, were 7.75%. And you actually had to pay 1 point in order to get it. So in this case, you had to pay $5,000 in order to actually get that rate, which broke down to a payment of $3,582 a month. But we took that same person with a 780 credit score, and not only did they not have to pay a point, they got an interest rate of 6.875%, so almost a full percent lower, which took the monthly payment down to $3,284 a month, which is a difference of $297. And that's a huge difference. But here's the crazy part is the mortgage insurance that's associated with the person at 640 versus 780 is almost a full 1% difference on the mortgage insurance, which is going to have a huge impact on that monthly payment. So understand, your credit score is super, super important. Take the time to focus on improving your credit versus rushing through the process. As I said earlier, your credit is going to have a bigger impact than anything else, because it's more important than your down payment in many ways, because it has such an impact on everything else. And while I know some people out there just want to get through the process and say, hey, I'm just going to get my loan, I'll work on my credit, and I'll come back and refinance later. Yes, that's definitely an option to consider, but I just want to stress how important your credit is. Now, if you're watching this video and you want to know some more differences between conventional and FHA when it comes to loan requirements, what you need to qualify, do me a favor and check out this video here.